Yeah, we're going to take another look at tax rates and finding what your taxes will be. An example, looking at the 2012 tax table, here from the IRS, it shows what we have for both single and married filing jointly. And our example is going to be a married couple filing jointly. So the situation is we have a married couple with no children. They have a gross income of $150,000. They put $20,000 in retirement and they're taking the standard deduction. So in order to find their adjusted gross income, you will take the $150,000 that they made and subtract the $20,000 that they put away in retirement. So they'll pay tax on that later once they're retired, but right now they don't have to pay tax on it. So they have an adjusted gross income of $130,000. Now, from that adjusted gross income, we will find their taxable income by subtracting a personal exemption for each of them. There's two of them, and the standard deduction because they're not itemizing their deductions. So this 11,900. So we're the married couple. So we're looking at this table. They have two personal exemptions plus a standard deduction. And we're going to use that in order to find their taxable income, which is 110,500. We did the 130,000 minus 2 times 38,000 plus 11,900. Okay, this $110,000 $110,500 is not going to be charged at exactly the 25% tax rate because their income does fall into the third bracket of this marginal tax rate. What we actually do is we divvy up that 110,500 and the first 17,400 of it is going to be taxed at 10%. And then the amount between 17,401 and 17,700, so if you just find this difference, that's going to be taxed at 15%. And then the remainder of their income from the 70,700 to the 110,500, that's going to be taxed at 25%. So we have a marginal tax rate of 25%, but their taxable income is going to be split into 3 buckets: a 10% bucket, a 15% bucket, and a 25% bucket. So what we're going to do is we're going to take this 110,500 and we're going to split it up into the different buckets. So 110,500. The first bucket is 17,400 because that's going to be taxed at 10% based on the table. The second bucket is the difference between 70,700 and 17,400. You're going to find that difference, and that is the total amount, that 53,300, that is going to be charged at a 15% rate. Okay, and then the third bucket is their earnings, 110,500 minus the part that you've already accumulated up here, so minus the 70,700, which is 39,800. So if you add 17,400, 53,300, and 39,800, you will get 110,500. And this is how you divvy up your income to be taxed at the different rates. So remember, the 17,400 portion of your income is at 10%, the 53,300 is at 15%, and the remaining portion of your income, the $39,800, is taxed at 25%. So on your calculator, you're just going to do 17,500 times 0.10 or times 10%, the 53,300 times 15%, and the 39,800 times 25%. I hope you're using your Google spreadsheet to do that. So your tax, 10% of 17,400, you can probably do in your head. That's $1,740. 15% of 53,300 is $7,995. And then 25% of 39,800 is $9,950. If we add these numbers together, that is going to add up to the tax that these people have to pay, $19,685. That's their income tax. That's not counting the FICA. Okay, so their effective tax rate, what you do is you take your taxes paid and you divide by your taxable income, and to make it a percent, you just multiply by 100. So they paid $19,685 in taxes. their taxable income was 110,500. They multiply that by 100, and so their effective tax rate is 17.8%. So even though they were in the marginal bracket, they were in the 25% tax bracket, not all of their taxable income was charged at 25%, because some of it was at 10% and then some of it was at the 15%. Their effective tax rate was only 17.8%. Another approach that you can see online sometimes to work these, and in some accounting books, is to look at the table. The tables are created just a little bit differently. They try to simplify the work for you. What they do is they just have you find where you are in the taxable income. So remember, we had a taxable income of 110,500. So we were in this this third row of the table. If this first thing is not part of the table because that's standard deduction. So we were in the third rate of the table. And so that meant that you were going to have a full $1,740 charged at 10%, and then the full amount, which was that 9,000 from the previous slide, 9,000 and something from the previous slide, and and so that, or I guess it was 8,000 something from the previous slide, and those two numbers added together give you this 9,735. And so another way to do it is just figure out how much beyond the second marginal rate you are. So from 70,700 to 110,500, that $39,800, just figure out what 25% of that is and add to this 9,735 that you already accumulated because you were in the third margin. You were in the third margin, so you had a fixed amount for the first margin and a fixed amount for the second margin. And so if you do it that way, you take your $9,735 plus 25% of the excess, which was $39,800. So it's $9,735 plus $9,950, which equals the $19,685, which was the same number that we got before. So that's just another way. Sometimes if you're looking online, it's a little bit different than the way that we calculated it, because we split ours up into buckets and we actually computed the part at 10% and then the part at 15%, and then finally the remainder that was at 25%. But either way, you get the calculations are the same. Okay. Remember, you should be using your Google spreadsheet. Be sure to watch the videos with the Google spreadsheet to help you do these calculations. I'd hate for you to be doing these by hand. I hope that you are using the spreadsheet to help you.